Hello, this is Dale, and this is part 3 of the very best way to trade stocks. In part 3, what I want to do is introduce a concept on the protective put. This is something that when the stock price has reached what you consider an overbought condition, you can put on a protective put, and that basically, if the stock drops, the put increases in value. So you're basically taking the risk out of your stock position. Now, I usually, once I buy a protective put, I will keep that on even after I sell the stock until it reaches an extended Fibonacci ratio, and I'm going to teach you that in this part. Then we're going to go over an actual trade example on DVN, Devon Energy, during the time period 2007-2008, the first part of 2009, when a lot of people lost a good deal of money from their 401k. Then on part 4, we'll come back. I'll give you 2 more trade examples. We'll review the rules again, and we'll talk a little bit about how you can start building up your portfolio. So let's go ahead and get into a discussion on a protective put. A very powerful concept. When you have a stock, let's say on this example was May 2nd, 2011, you had 100 shares of DHR, Danaher. And Danaher was trading at $55.05. So for 100 shares, you had an investment of $5,505. But you were feeling uneasy. Danaher had a pretty nice little rise. You wanted to protect your profits, but you weren't sure and you didn't want to get out of the stock just yet. What you could do is buy a protective put. And what I want to do is buy a put that is 10% in the money. ITM is in the money. What that means is you are buying a put that already has intrinsic value. See, for an option, a put or a call, an option premium is based on 2 things. One, it's time value, and the other is it's the intrinsic value. If you buy a put at 60 and the stock is at 55, it already has a value of $5 because you can go ahead and sell that stock, that put, for $5, and at 60, because the stock is at 55, it's $5 lower than the strike price of 60. For my protective put, what I want to do is take the price of the stock, which in this case was $55, and I want to take that times 10%. In this case, that would be roughly $5, $5.50. I want to add that to the 55, and that's going to give me the strike price that I want to buy. So I want to buy a 60 put, and that is 10% in the money. Why do I want to do that? Well, I don't want to go too far in the money because it gets too expensive, but I want to go far enough into the money so that the delta is at a good level. Now, at a 10% in the money, the delta is going to be about 0.8. Well, what does that mean? What that means is for every $1 move of the underlying stock, the option will move 80 cents. The delta is a calculation using the Black-Scholes equation. So basically what I've done is when I go and buy a put that is 10% in the money, it has a delta of 0.8, so that for every dollar move of the stock, I'll get 80 cents move on this option. Therefore, I've got a vehicle that's going to track the underlying stock very closely, but at a fraction of the cost. The 10% in the money 60 put costs $5.80, which is 1/10 of the size. I bought this put to protect my $5,505 investment. One other thing I want to do is I want to go out about 100 days, which is about three months. 3 or 4 months I want to go out. See, you notice this was the beginning of May. I went out to September to give me enough time to have protection on my stock. All I have to do is on May 2nd, I go into my trading platform, and for every 100 shares of stock I have, I buy. In other words, if I had 500 shares of Danaher, I would buy 5 protective puts. For every 100 shares, I want to buy 1 protective put. I would buy 5 September 60 puts at $5.80, hit the button, and your stock, your $5,500 investment, is protected. Okay, here's a chart of Danaher during the time period that we're talking about, and you'll notice that it was above the +1 on the regression channel. Therefore, when it got to this area, what do? I prepare myself to buy a protected put and sell the stock. I'm preparing myself, but I'm not doing anything just yet. I'm not doing anything just yet. Because you can see that once we are overbought, it can stay that way for quite a while until right here, right around May. I think it was right around May 14th or something like that. It dropped below the -20 on the Williams. When it did that, and when the money flow is going out, when I have those 3 things happen, I've gone above the +1. It's gone below the -20 on the Williams, and the money flow is going out. That triggers a day where I want to buy a protective put. When I buy the protective put, now I can sit there and watch for a while and decide, do I want to hold on to this stock or do I want to sell the stock? Well, that's when I go over to the day chart, and you'll notice that this was the time period where we bought the protective put right around here when it was 55.05. You'll notice on the day chart it came down, it pulled back, and came back down again and made a lower low. A lower low. This is called a measured move. When the stock price is going in one direction, stops, goes in the other direction, and then makes a lower low, in this case, that is a measured move. I bought the protective put up here, so I'm protected, and now it made a measured move to the downside, A measured move to the downside is a very good indication that the trend has changed. When I have a protective put and I still hold on to the stock and I see a measured move, I then go ahead and sell the stock. The only thing I'm left with then is the protective put. And I can choose to sell that protective put anytime as it's going down here. Well, how am I going to decide when I'm going to do that? That's when I'm going to use the Fibonacci's. But this protective put on Danaher saved a $13.05 drop. On May 2nd, 2011, when Danaher was at 55.05, we bought the September 60 put for $5.80. Danaher then dropped over the next period to September 5th all the way down to $42 even. That's a $13.05 drop in the stock price. Well, let's take a look at what happened to the put. See, when a stock price drops, a put increases in value. It's exactly opposite from a call. The put that we bought on May 2nd was worth $5.80. On September 5th, that September 60 put was worth $17.50. That's almost, well, what is that? It's about almost a $12 increase in value on the put, where the stock dropped $13, okay? And there we come into that delta of 0.8. So by buying a protective put, we saved that total drop. Not only that, but we made money on the protective put. The other thing that we're going to do is we're not going to hold on to that stock all the way down here. When we see a measured move up here, which indicates a change of direction, I'm going to go ahead and sell the stock outright. So now I'm left with only a put. And I'm going to take that put all the way down, and I'm going to get out based on the Fibonacci's. Now, what's the advantage of this? Well, I'm going to start down here when I get another chance to buy Danaher, and I'm going to buy it at a much lower level. So basically, it's like I've had Danaher up to this point, and now I've made money on my put, and I'm going to continue on with my investment without taking any drop at all. If you take a 20% drop in the stock price, you've got to make 40% back to be to that level. Okay? If you've got a stock that's worth $100, it drops to 80. Okay? You've got to earn the 20 back plus another 20 to be to the point where you would have been if it would have just went up 20. So capital preservation and buying protection so that you minimize your losses is a great strategy. Okay, let's say the Danaher price of the stock drops, and at any time you can decide, hey, I'm going to sell the stock. It doesn't matter. It doesn't matter. Okay? You go ahead and sell the stock now, and what you're going to do is you're going to want to hold on to the put until it gets to an overextended position on the Fibonacci's. And I'm going to talk more about the Fibonacci's, but let's just take a look at the chart here of Danaher during the period where we were selling the protective put. Fibonacci is when you take when you start from the high, you come down to the low and then to the lower high, and this is called a measured move. When it does that, when it makes the measured move, you can draw Fibonacci's on here, which you can do automatically on your Thinkorswim platform. And I'm most interested in the 127, the 161, and the 261. These are what I would call overextensions. So that move might be close to being over. You can sell that put at any point in time along here. And you'll notice that this, when it came down to the 261, it sat there and consolidated for a while before it finally went back up, and we bought back in. So we had a put. We had a put all the way down here because I was really focused. Then it came roaring through the 161 so fast, I let it go all the way down to the 261.8. Well, what do these numbers mean, and how are they derived? Fibonacci extensions and retracements, we're going to talk mostly about the extensions here. They're found throughout nature. I'm going to talk about that. I'm going to talk about the golden rule. It starts with a measured move, and we're going to look at these full extensions, the 127, the 161, and the 261. Fibonacci ratio is commonly seen throughout nature. As you go up the stem of a flower, the leaves grow at a proportional distance to the Fibonacci ratio. The spiral of seashells are proportional to the Fibonacci ratio. The distance of the human forearm to the hand is proportional to the ratio. The distance of the bones in the leg are proportional to the Fibonacci ratio, etc., etc. The Fibonacci ratio is a mathematical ratio that is seen everywhere. Well, if the Fibonacci ratio is seen everywhere, doesn't it make perfect sense that the markets would move in perfect harmony with the Fibonacci ratio? The golden rule. First of all, the Fibonacci are derived, it's a number sequence. Starts out 0, 1, and what you do is you add the current number to the previous number to get the next number. So you have 1 plus 1 equals 2. 1 plus 2 equals 3. 2 plus 3 equals 5. 3 plus 5 equals 8, and so on. This is the number sequence. Then, if you take any previous number as the numerator and use the next number as the denominator, you'll come up with 0.618 every time, and that is called the root Fibonacci ratio. Now, if I take that 0.618 and I take the square of it, I'm going to get 0.382. If I take the square root, I'm going to take 0.786. Now I'm going to take the reciprocals of that, and these are the Fibonacci's I'm going to use for extensions. These are all indications that a move is overextended. 1.27, 1.61, 2.61. This is exactly what we saw on the previous chart. 1.27, 1.61, 2.61. Notice how if it goes strongly through this one, it'll go strongly through this one until it finally, sometimes it will even consolidate a little bit at one of these before it drops to the next level. This is not, I really focus on these as being potentials to take profit. Well, if it gets down to the 127, you've already made a pretty healthy profit. If it blasts through the 161, I'll sometimes just wait, but never letting it go any further than the 261 before taking some of that profit. Okay, here's that same chart. So it's the combination of when the stock goes up and it turns around a little bit and it's above the +1 on the regression channel, it turns around and it goes below the -80 on the Williams, and the money flows going out. You want to buy a protective put. When you get a measured move, you want to go ahead and sell the stock. When you have a Fibonacci extension, you want to go ahead and sell the protective put, and you want to wait till you get another buy signal when it's down below the -1 on the regression channel. Time and time and time and time again. This is how you time when you buy and sell stock. And you're doing it on the 25 financially strong stocks that I've shown. Now I want to go over an actual trade example of Devon Energy Corporation. And I'm going to talk about the period between March 2007 and February 2009. And I want to show you how I actually made money during this period of time, where a lot of people were losing their life savings. I want to teach this to you so that you can manage your own portfolio and this does not happen to you again. This is a chart. I'm showing actually a 15-year weekly chart over here because I wanted to show you the time period that we're going to be looking at. It was a very volatile time period for Devon Energy. We're going to be looking at, I think this is my first buy signal down here. We're going to be taking it during this period. We're going to take it all the way up here. We're going to sell. We're going to take it all the way down here and buy again. Okay, so we're going to focus on this time period. This is the daily chart during that time period. You can see how Devon was having a very nice rise, and then just like everything else, it got pulled down in 2008. And when did we get out, and how did we protect ourselves with a protective put? I'm going to show you exactly how we did that. We're going back in time here. This is March 15th of 07. You'll notice that Devon came down. It was below the -1 on the regression channel. So we're preparing ourselves to buy stock. It went ahead above the -80 on the Williams %R, and the money flow was going up. When we get those three things together, we are prepared to buy stock. We bought 100 shares at $64.03, right around here, on March 15th, 2007. When it finally came up to it, we went almost 9 months of very strong performance by Devon Energy till right around the November time period. It went above the +1 on the regression channel, and you'll notice that right around that time period it went down below the -20 on the Williams %R, and the money flow index was trending down. Those three things coupled together mean something might be changing. Why don't I buy a protective put? At that point in time, I bought a protective put. I went out to the March, and Devon was right around 90. It's right around 92. So we take 10% of that is about around 9. We add it to that. I got a March 100 put, 10% in the money, for $16.50. That was protecting that was protecting my investment of $9,000. Okay, you're always going to get about a 10-to-1 ratio there buying your protective put. So for 1/10 the price of my investment, I am protecting that. This is the time period at which I sold the protective put, and you'll notice that what we have here, this was a change of direction and a measured move to the downside. Now, if you don't understand the measured move and it doesn't make sense to you, that's okay. That's okay. When you had a move like this, I think you probably want to get rid of the stock. Go ahead. Go ahead. Sell. We sold 100 shares of Devon on 11/10/07 for $91.50 a share. What did we buy it at again? Oh, $64. Took it on up to $91. Now we bought a put to protect that investment. And at this point in time, we went ahead and finally sold our Devon. So the only thing we're left is with the put. Here's the trade rack up. Devon, we turned an $11.47 price drop into a very nice profit. And here was the sequence. On March 15th, 07, we bought 100 shares at $64.03. Then Devon went up to around November. It started to turn around. Came down below the Williams -20. Money flow was coming out. It was above the +1 on the regression channel. We bought a March 100 put, $16.50. A couple days later, we saw that we had a measured move, so we went ahead and just sold. We got rid of the Devon for $91.50 a share. So we had this close to $2,500 in profit. Now we're working on our protective put. We took that all the way down to the Fibonacci 161, and on January 23rd, we sold this for, this was actually 09. This was actually 09. January 23rd, 09. We sold our March 100 put for $39. So we doubled our money here. So we've got, we had, on $11.47 price drop on Devon, we made, close to $5,000 on, and this is 100 shares, one put. 100 shares, one put. Your portfolio is liable to have a lot more than that. So you're turning a price drop into an extreme profit by using this strategy. Let me just go back there to this and see what we did here. Remember, we bought this here when it was below the -1 on the regression channel. Came up over the -80 on the Williams. The money flow is coming in. We bought the stock. As long as it's within the channel, we're going to stay with it. We're going to stay with it. And remember, stock doesn't go straight up and straight down. But as long as it's within the channel, just stay with it. Relax. Everything's okay. Because you can see that, when we bought Devon, we bought it for around $64. It was as high as 83 and pulled back all the way to 70 before it went up to 90. This is the way stock performs. As long as it stays within the channel, stay with it. We stayed with this till we got up here. It was above the +1 on the regression channel. It was below the -20 on the Williams. The money flow was going out. We bought a protective put. We got a measured move. We sold the stock. and rode it all the way down to a Fibonacci of 161, which I think was right around this level, and we finally got back into Devon right here. Okay, I hope this example kind of solidifies what we're talking about here. It's a very simple process. You know, we're only looking at the regression channels, the Williams, the money flows, so there's not a lot of conflicting information coming in here. We're disengaging our brain from the talking heads from CNBC because we're doing our own thing here. We're either holding on to the stock or selling it at whenever you want to. I look at a measured move, and it's this process we do time and time again that will allow you to manage your own portfolio and allow you to be a successful investor now and in the future. That's the end of part 3. In part 4, I'm going to come back and give you some more examples. We're going to review the rules again, and we're going to talk a little bit about starting to build your portfolio. I hope everybody enjoyed this. I enjoyed doing it. I can't wait to come back for part 4. Bye-bye now.